Right now, we're watching an absolute unprecedented frenzy in the market. Huge names, I'm talking SpaceX, OpenAI, are finally opening their doors to public money. So welcome to this explainer where we're going to dig into this massive wave of tech IPOs and, more importantly, what it means for your hard-earned money. Look, it's easy to get swept up in the headlines. It feels like everyone is getting rich overnight, right? But beneath the surface of all this record-breaking enthusiasm, there are some serious macroeconomic cracks starting to show. Today, we're going to break down exactly what's happening in this AI IPO gold rush, why the urgency is so high, and how you can position yourself to avoid the traps that are quietly catching off-guard investors. To really understand the mood right now, we have to start with this grandiose vision directly from Elon Musk's SpaceX prospectus to extend the light of consciousness to the stars. I mean, wow, it perfectly captures the staggering hype dominating the market today. When you read through the official documents these companies filed to go public, you aren't just seeing your standard dry financial projections anymore. You're seeing literal science fiction pitches, Mars colonization, in-orbit data centers, multiplanetary systems. And it's visionary, absolutely. But it also creates this wild atmosphere where investors are basically buying into a dream rather than closely scrutinizing the actual present-day financials. And the sheer scale of that dream is staggering. $1.75 trillion. That's with a T. SpaceX's IPO is breaking historical records with a valuation between 1.75 and 2 trillion. To put that into perspective for you, they're immediately displacing deeply established tech giants to become one of the most valuable companies in the entire United States, despite having revenues that don't even crack the top 200 list. And the kicker? They're doing this by directly targeting retail investors, everyday people like us, to help fund these massive ambitions. Act 1. The headline hype. Let's really look at the numbers. There is a massive cash boom happening right now across the AI sector. This IPO gold rush goes way beyond just SpaceX. It includes giants like OpenAI and Anthropic too. Look at OpenAI on this table. They recently hit an estimated $852 billion valuation, right? Yet they are projecting a mind-boggling $600 billion in computing spend by 2030. That vastly outpaces their annualized revenue of around $25 billion. It's like a giant furnace. Even SpaceX is seeing the majority of its capital expenditures being eaten up by its AI segment. The reality is, these companies are scrambling to go public right now because they need an astronomical amount of cash just to keep fueling their AI infrastructure. And because they need that cash, look at how aggressively they're courting regular, everyday investors. Historically, the best IPO allocations were strictly locked up for institutions and ultra-wealthy clients. But today, the barriers are being completely slashed. SpaceX is reserving up to 30% of its shares for individuals. Brokerages like Fidelity have dramatically lowered their minimum capital requirements from $500,000 down to, get this, just $2,000. Sure, they're democratizing access, which sounds great on paper, but they are doing it exactly when these companies need an unprecedented influx of cash just to survive. Act 2, the macro reality check. To truly grasp what's happening, we got to step out of the AI bubble for a second and look at the broader economy. 4.2%. That's our CPI inflation spiking right back up. A huge chunk of this is being driven by energy shocks from geopolitical conflicts in the Middle East directly impacting global oil supplies. And this resurgence of inflation, it has completely thrown a wrench into the stock market's expectations for imminent, easy interest rate cuts. So instead of that era of cheap money that traditionally fuels these massive tech booms, the Federal Reserve is basically forced to pivot. With inflation rearing its ugly head again, the new Fed chair, Kevin Warsh, has signaled that interest rates will likely need to stay elevated throughout 2026. This puts a huge strain on the broader economy. It increases borrowing costs for everyday consumers, and it severely threatens the easy money environment that these highly valued IPOs desperately rely on to sustain their crazy growth. Now, if you know market history, this next part is pretty alarming. Bursts of giant money-losing IPOs usually cluster right near market peaks. Today, the S&P 500's price-to-earnings ratio is sitting near 40. We've really only touched that level once before, right at the absolute peak of the dot-com bubble in the year 2000. Bank of America is even waving a massive red flag, noting that 17 out of their 20 valuation metrics are currently flashing overvalued. The environment right now is heavily praised for absolute perfection, and we all know markets are rarely perfect. Act 3. Are you exit liquidity? Let's talk about the insiders. This brings us to a harsh but absolutely necessary question. As a retail investor buying into this AI hype, are you really getting a ground floor opportunity, Or are you just acting as exit liquidity for the insiders? When you look at every tech IPO over $1 billion since 2010, the surface level average looks fantastic, right? Up 248% in 5 years. But wait, that average is heavily skewed by a few rare explosive winners like Shopify. When you strip away those outliers, the data shows a much more sobering reality. The median tech IPO actually loses 7.4% of its value 6 months after its first trading day, and it's still down a full year later. Let's visualize this with SpaceX. Despite all the glowing headlines about opening doors for retail investors, the public float, meaning the shares actually available for you and me to trade, represents just 4.2% of the company. That means a whopping 95.8% of the company remains tightly controlled by private insiders, early investors, and Elon Musk himself. And you know, the timing of this IPO is really critical to understand, because roughly $1 billion of those closely held insider shares are scheduled to unlock and become eligible for sale within the next couple of months. So this raises a totally valid concern. Are original private investors just using this massive wave of retail money pouring in right now to quietly cash out their positions at record high valuations? It's definitely something you have to think about. Furthermore, the valuation premium you're paying to buy in right now is just astronomical. SpaceX hit the market with a price-to-sales ratio of roughly 90. Meanwhile, highly profitable, established AI giants like Google and Meta, they sit at a ratio of just 10. You are paying a massive premium for the promise of the future, and that leaves literally zero margin for error if these companies stumble even a little bit. Act 4, the balanced view and the bull case. Now, as your financial explainer, I gotta be fair. Writing off the AI boom entirely as just some speculative bubble could mean missing out on a genuine, world-altering technological revolution. The hype isn't completely manufactured out of thin air. Look at this recent quote from Google's earnings statement. They straight up said enterprise demand for AI infrastructure is incredibly real. In fact, it is severely outstripping supply right now. These tech giants are literally constrained by their ability to build enough data centers and secure enough compute power to satisfy the market's thirst. The demand is definitely there. We also got to remember that acting strictly on fear can be incredibly costly. Yes, those Bank of America valuation metrics are flashing red today. But, the exact same checklist hit that 70% warning threshold previously, right before the market just kept rallying another 20%. Anyone who panic sold based on those overvaluation warnings ended up completely missing out on massive gains. The old saying is true, markets can stay irrational and overvalued for a very long time. Act 5. How to protect your money. Let's get practical. So how do you actually navigate this complex landscape? We've got AI promising to reshape the world on one hand, but we've got stubborn inflation, high interest rates, and insider sell-offs threatening to crush portfolios on the other. Well, you gotta start by protecting yourself against this sobering macro reality. The U.S. personal savings rate has plummeted to just 2.6%. That is the lowest level we have seen since right before the 2008 Great Financial Crisis. So while the stock market has been breaking records, the actual amount of cash everyday people have left over at the end of the month is rapidly collapsing. Behind all the flashy headlines of average wealth soaring, the typical American is really struggling. Vanguard's data shows the median 401k balance is a mere $44,000. And even worse, a record 6% of participants are taking hardship withdrawals. People are literally being forced to raid their own retirement futures, eating hefty penalties in the process, just to pay for present-day emergencies. It is the clearest picture of a K-shaped economy, where the top soars into orbit and the middle just gets totally squeezed. Therefore, the most actionable takeaways from all our financial sources today are simple, but they are absolutely crucial. First, prioritize building a 3 to 6 month cash emergency fund in a high-yield savings account. Second, always capture your employer's 401k match. It is literally free money. Don't leave it on the table. Third, automate your investments into broad, low-fee index funds so you aren't dragged down by hidden management costs. And finally, absolutely avoid FOMO. Do not let the fear of missing out push you into speculative, wildly overvalued IPOs at the expense of your financial foundation. I'm going to leave you with this final thought to really consider before you hit that buy button on the next trillion-dollar IPO. The investors who ultimately win in the long run aren't usually the ones aggressively chasing the absolute hottest trends. They are the ones who build an unbreakable safety net first. Thanks so much for joining me on this explainer today, and I really hope this data helps you navigate the incredibly complex market ahead of us. Keep your eyes open and trade smart.